Hey guys, Richard Matthews with Matthews Wealth Management. We're going to be talking about tax control, specifically Roth conversions, but I want to lay a little bit of groundwork about what is the difference between Roth and traditional and SEP and all these different IRAs. So what that boils down to is a triangle I use to illustrate how we can take advantage of the different types of taxations in our savings accounts, whether it's for retirement or even short-term savings. Specifically, as we are currently in a market downturn, there's an enormous opportunity we want to take advantage of. So, without further ado, tax control. The first thing that I want to illustrate here is what we call after-tax dollars that get taxed again. So an example of this would be a checking account, savings account, real estate works this way, as well as what we would call non-qualified or individual brokerage accounts. So you can buy stocks and bonds in this format, but we'll just say non-qualified. So the way that this type of system works for taxation is you are investing $1. Now you've already paid your taxes in a paycheck, so we can call it a paycheck dollar, but let's put a little T here because you've paid some tax on it. So you invest this over a certain period of time, make a certain rate of return. Let's say that we come back and now it's worth 10 bucks. All right, so the $9 difference that we just made, we're gonna have to pay taxes again. This is what we call capital gains tax. All right, so there is a short-term capital gains. In our example, we're gonna use long-term capital gains because this is a long-term investment. The flip side of it that I wanna illustrate is how our retirement savings works. This is where 95% of retirement dollars are currently being saved. These are pre-tax dollars that get taxed later. So instead of our dollar, we've really got $1.25 or $1.15 or whatever your tax bracket is. Instead of paying that paycheck tax amount, you're actually going to get to take it out pre-tax and let it grow. And there's a tax-deferred compounding interest allows this investment for the same amount of time, same rate of return, to compound quicker. And that's why a lot of people like to use this for long-term retirement savings. So hypothetically, same investment, same period of time, now we're looking at 20 bucks that's invested here. The only difference is instead of paying the capital gains tax, which is a flat tax rate, we now have to pay a tax on the total amount, and we're talking about income brackets. Okay, so the more you make, the higher the percentage you pay. All right, the last area I want to illustrate is the after-tax dollars that get taxed never again. So examples of this would be a Roth IRA. This would be the 529 plan for college education savings, as well as municipal bonds that can fall in here. Sometimes you can hear about cash value life insurance. Ignore that unless you're part of the 1%. But these are the typical ways that we would save in the after-tax tax never again. So the idea is the same dollar that is a paycheck dollar grows to whatever. It's never taxed again. So obviously that's the best place to save, right? So the IRS realizes that. They put a lot of limitations on how much you can contribute, how much you can take out, when you can take it out, what it can be used for, etc. So whenever the IRS limits you, it's worth investigating. So let's go through a hypothetical example and say that once you get into retirement, you're going to need to draw out of your Social Security, out of your IRA, your 401k, you may have a pension or something else, but say you need to live on $100,000 after tax, all right? So you're gonna be drawing from pretty much everything over here. We've got Social Security, 401k, traditional IRA, pension, etc. There's a number over here. But once we take those out of there, let's assume on our need of $100,000, we're now in a 33% tax rate. So this is a math question I ask clients to kind of put them on the spot and illustrate how much we underestimate what this tax actually is. If we need to have $100,000 after we pay our taxes, how much do we have to have gross? Most people say $133,000. The reason I do this illustration is to kind of emphasize it's actually $150,000 because a third of it is 50. So the problem that we create is that $50,000 is going straight to the IRS, leaving us with 100. So even though this thing grows the best, because of the tax rates that are adjustable and grow as our cost of living grows, we end up paying a very large tax liability. So let's look at possible solutions. The first idea, the easiest idea, would be instead of having 150,000 all in this corner of the triangle, what if we were to split it out a third, a third, a third? Okay, so we've got 50,000 in this corner. We've got 50,000 in this corner, and we've got our 50,000 basically in a Roth or municipal bonds. So first we'll talk about this 50,000. Remember, we're paying capital gains tax. So I'm going to assume the worst case scenario, which would be that all of this is taxable. It's all long-term capital gains. Well, that is a 15% flat tax. So 15% of $50,000 is going to be $7,500 of tax that we'll have to pay on our withdrawal here. Now, out of our retirement savings, we're paying income tax. So we've just taken a pay cut from $150,000 down to only $50,000 that we have to run through our tax brackets. So what happens to our tax rate? Does it stay the same? Does it go down? It does go down. It goes down, let's say worst case scenario, 25% still. 25% of $50,000 withdrawal is going to be $12,500. So when we take our $50,000 out of our municipal bonds or our Roth IRAs, how much do we pay in taxes? Nothing. Never. We never pay taxes again. So that's going to be zero, right? So when we bring in our $12,500, our $7,500, and our zero, we're paying a grand total here of $20,000 as opposed to $50,000. So this illustrates we're not saving any more dollars out of our paycheck. We're not having to cut our expenses and live less now for later. What we do is that we have tax efficiency. We have diversification around the types of taxation that we choose to pay. So as tax brackets change, as flat capital gains rates change, or if they were to make changes on whether you can make contributions to Roth IRAs in the future, at least now we can pick and choose how much we want to withdraw from each of these corners to generate our own tax bill, and therefore we have tax control. So when we come back, we're going to talk a little bit about Roth conversions and how we can take advantage of those. All right, we're back. Last time we talked about the tax control triangle and talked about the different ways that we're taxed on our savings. This time we're going to put it a little bit into practice with what we're experiencing now with the market downturn. So in this example, what I want to do is take a look at our hypothetical traditional IRA, 401k, anything that's tax deferred and has a $100,000 balance. So the first thing we need to look at is what is the after-tax buying power of that account. So if we assume 33% tax rate, that means that the after-tax value of that traditional IRA is actually $66,667. So that presents the problem. So when we look at what a downturn does, we can find a solution as a way to start minimizing our taxation. So that same traditional IRA of $100,000 we have over here. Let's say we've experienced a 20% market loss, and so now our statement balance says $80,000 on a traditional IRA. This is when we want to look at employing the Roth conversion. So in this hypothetical, we're taking a quarter of the balance and putting it into a Roth IRA through a conversion. You do have to pay taxes on this. There's a lot more to it, but just for showing you the concept behind the strategy here, you still have $60,000 remaining in your traditional IRA. So let's assume that we get a market rebound, right? And so if we lose 20%, it takes 25 just to get back to where we started. So our $60,000 now grows with a 25% gain to $75,000, okay? The Roth IRA at 20 gets the exact same gain. We're investing it in the same underlying funds, and now it's at $25,000. So the 75 traditional, the 25 Roth, we're back to our original $100,000 when we look at our statements. So our $75,000 traditional IRA, let's assume the exact same tax rate. We're still going to have to pay our 33%. Our Roth, we pay nothing, right? And our taxes on any gains in the future, including these gains that we've seen on the recovery. So our after-tax value on the traditional IRA is $50,000. Our after-tax value on the Roth IRA is $25,000. So our after-tax value on the total $100,000 now is $75,000 here. So you look at $75,000 versus our $66,667. It's over $8,000 of extra after-tax dollars that you can spend without taking any more risk, paying any more fees. It's really just about managing your tax strategy. So hopefully this helps when it comes to actually calculating how much to do a Roth conversion. You need to work with professionals. Your tax professional is important, as well as your investment professional, to make sure you're doing the proper paperwork. So don't take it lightly, do it arbitrarily, but this is the concept of Roth conversions during a market downturn that could really help you. Join us next time. Look forward to seeing you.